financial literacy. Now, some of the concepts that you are going to do, we did them from grade 7. So you'll be familiar with some of the topics as we go on. And then we are going to start with explaining what is a sole trader. Now, a sole trader is a form of ownership, and it's a business that is owned by one person who owns the business, who manages the business, who do everything with the business. The sole trader is fully responsible for all the debts of the business, and he is entitled to all the profits of the business. And then the second thing is that we have two types of sole traders or two types of businesses. In fact, we have 3, but the other one we are going to do it in FET in grade 10. In grade 8 and 9, we are only doing the service business, and we also do a retail business or a trading business. Now, when we speak of a service business, we are referring to a business that renders a service to the community. When you talk of a service, we are talking of something that we cannot touch. It is something that is not tangible, meaning this type of businesses is a business that provides service like the doctors, the dentists, the attorneys, the hairdressers, the electricians, and the plumbers. They are providing a service. They are not selling any goods that you can touch. Now, talking about the retail or trading business, it's a business that buys and sells goods that are tangible. Like in a supermarket where you are able to buy groceries, or an example can be also a clothing retail. And then the other concept that we are going to explain is a debit and a credit, because these are the concepts that you're going to use more in grade 8 and grade 9. Now we use the debits and the credits in the ledger accounts. The ledger account has 2 sides. The left-hand side is called the debit side. The right-hand side is called the credit side. Now, according to the double entry principle, for every debit, there must be a credit, meaning in a transaction, in a business transaction, the transaction is recorded twice, where we debit it and also we credit it. And then here's a double entry principle. For every debit, there must be a credit. For every left, there must also be a right. And then the next concept that we are to explain is capital. Capital is the amount of money the owners contribute to start a business. The owner may use his or her own savings. The owner may get a loan from the bank so that he can be able to start the business. Then we have 2 types of capital. We have the fixed capital, and this is the type of capital that we use to buy assets that are not consumed or destroyed in the production of a good or service and can be used for the production process, meaning we are talking of the machineries that you are going to need. We are talking of the equipment. We are talking about the buildings that you are going to operate in. And then we also have the working capital or the operating capital. This type of capital is a capital that we are going to use to pay for our expenses, is a capital that we are going to use to pay for our liabilities. Now, this is the cash used for daily operations in a company and is essential for the survival of the business. Now, the next concept that we are going to explain is the owner's equity. The owner's equity is the total capital contribution or the investment the owner has made to the business. Now, for us to be able to calculate the owner's equity, we have the owner's equity equals the assets minus the liabilities, meaning If we minus all our liabilities from our assets, the difference that you're going to get there is called the owner's equity. Now, the next concept is the income that you started with in grade 7. And income is the money that a business receives from rendering a service or selling goods. And income increases the owner's wealth in the business. And we also have the concept accounting, which means the recording of transactions in the business financial books. And a business can also have a loss if our expenses can exceed our income. A loss is a shortfall which occurs when the expenses of a business are greater than its income. No business wants to run at a loss, meaning losses are bad for any business. A loss is when the expenses of a business exceeds its income. And then what are these expenses we are talking about? Expenses are payment made for goods or services needed to run a business on a day-to-day business. Expenses are payments that decrease the owner's wealth, meaning that they are going to decrease our owner's equity. And then for each and every business, the aim is to make a profit. And what then is a profit? A profit is the difference between the money received or the income and the payments made when the income is more than the expenses. The main aim of the business is to make a profit, and this is known as the profit motive. And then the next concept is the transaction. A transaction is a term for a business deal. A transaction takes place when money or items of a value are exchanged between one or more people or business. The next concept is the liability. Liabilities refers to the money owed to other businesses or to financial institutions or persons other than the owner of the business. Examples of liabilities can be a loan, can be a bank overdraft, it can be the creditors which are the people that are selling to us on credit. And there are two types of liabilities, which are current liabilities and non-current liabilities. Now, what is the difference between current liabilities and non-current liabilities? Current liabilities are debt that must be paid within 1 year, meaning they are our short-term liabilities. And then this can be creditors or money owed to suppliers or bank overdraft or an income tax. A creditor is a supplier that the business buys goods from on credit, whereas a bank overdraft is when the bank allows you to spend more than there is in your bank account. And then sometimes you can also owe SARS, where we owe the government on personal income or profits in our business. Now, what are non-current liabilities? Non-current liabilities are the debts that are repaid over a period longer than a year. An example can be a mortgage bond, a loan to buy business premises, that is the buildings or a house, usually over 10 or more years. And then we also have the car finance, which is a loan to buy a car, usually over 5 years. And then we also have loans which can be more than 1 year, when you pay a loan over a longer period than a year. And then we have assets. These are the positions or belongings of a business or an individual. There are two types of assets. We have the fixed assets, and then we also have the current assets. The difference between the fixed assets and the current assets: fixed assets are permanent in nature and are bought to be used over a long time. Examples of fixed assets may be the land and buildings, the vehicles and equipment. The current assets, these are current assets that can be converted into cash within a year. These are assets of a temporary nature. For example, the stock that we buy with the aim of reselling it, the people that owe us money that we sold to them on credit, the bank account, the cash float, and petty cash. Now we also have a concept of banking, where banks or different financial institutions offer different types of accounts. But businesses normally open a current bank account, also known as check account. A current account is used for day-to-day activities. Banks offer other services that are useful for the business, which include depositing and withdrawing money from the current account. And then we have cash receipts. All money received by a business and deposited in the business bank account are called cash receipts. All cash receipts must be all cash transactions must be recorded on source documents. These documents are then recorded by the bookkeeper in the books of the business. A business receives cash from services rendered, that is cash sales, rent income, interest income, and debtors payment. And then we also have cash payments. All the money that a business pays out is called cash payments. All cash payments transactions must be recorded on source documents, and these documents are then recorded by the bookkeeper in the books of the business. Payments made by the business include the purchase of assets, trading stock, expenses such as telephone, repairs, training license, and the rent paid. And then we have subsidiary journals. Every transaction begins with a source document. A source document is a document that is proof that transaction took place. It's an evidence that the transaction took place. The information from the source document is entered into journals. Journals are the recording of every income and money paid. We have the cash payment journal, and we also have the cash receipt journal. Subsidiary journals are books of first entry wherein all different transactions are recorded before they are entered in the journal. And then all our receipts, meaning that all the income is recorded on our cash receipt journal, and all payments are recorded in the cash payment journal. And then our most important concept is the accounting equation. The accounting equation is assets equals to owner's equity plus liabilities. Now, the accounting equation is the fundamental rule for recording financial transactions according to the principle of double entry. And that we already talked about, that for every debit, there must be a credit. And then I think this is our last concept that we are to do for the day. And thank you very much, everybody, for your time. And please make sure you completed the attendance register. Thank you.